Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, John, welcome to Pilot Money Guys, man. Thanks for joining me today, and thanks for being my co-pilot. Is that appropriate to say?
I like it. I'm
co-host.
I pride myself in being the co-pilot. I'm your best pilot monitoring.
We don't use that term very often anymore, do we? I mean, it's kind of like captain, first officer. Pilot's a little bit of an older term, but nonetheless, you're my co-host today, and this is your area of expertise. We're going to talk money and psychology today, and it's a topic that you and I both love. But first, before we jump into that good stuff, tell us about you, man. Why are you here? What are you doing? Why are you in a hotel in Anchorage?
Yeah, so I'm out on the road right now, in between trips. I came in from Newark and I'm headed to Memphis. So I'm sitting in Anchorage, Alaska, and that is the life of the airline pilot. So we're doing this live recording in the hotel in Anchorage.
Right, thanks for joining me. I love it when you're on the road because you're like a captured audience. I can just go, I know you have hours in the hotel, so let's do this.
All right. I love it.
Yeah, man. Awesome. So you are obviously one of our pilot advisors at Leading Edge, and you also are in the Air Force Reserves. You've got a family out in Enid, Oklahoma area. Enid by the sea. That's what we call that, right? So,
yep.
So what's going on?
Enid, America.
Yeah. Tell us what's going on in your world, man. Something exciting personally. What are you excited about right now?
Oh, well, I actually, I love this book that we're talking about, Psychology of Money, but I think that it's probably best to just kind of like start with how I got here.
Yeah.
So obviously I have multiple jobs, and flying has been always my primary job. But finance has kind of trickled its way into my life over time. I went to the Air Force Academy. I studied psychology undergrad, so behavioral sciences and human factors. So human factors is essentially how humans work with machines. We do a lot of it's big in aviation, it's big in the medical industry, it's big in energy, but it's basically the study of the efficiencies and how humans work with machines. Like what's the best decision to make, and how the engineers put avionics in cockpits, and how the medical field, draws data in order for humans to basically diagnose data and come up with the best decision. So I would say that that's led me down the path to money. It's always kind of been in the background for me. I'm always interested in it. The stock market is fascinating. But I think human factors play a lot into financial planning. And the book by Morgan Housel, The Psychology of Money, plays into all of those nuances about what is important and how do we seek happiness. We always talk about money as a tool more than the actual, item that it is, but a tool that provides somebody with peace of mind and resources to go out and do the things that they love and enjoy. So I think that's, where we'll go with all of this.
Yeah.
But psychology has always just leaked its role into my life, and pretty much everything we do day to day is you can bring it back to some psychological effect. So
yeah.
That's the exciting topic, and
Nice.
so my background covers components of that. So hopefully I'll be able to jump in and give you some insight over how the psychology world looks at all of these things we're discussing.
Yeah, that's fascinating, man, because the human factors and what we call CRM in the world of flying, to me, is a directly applicable to our lives as investors, and all of us are investors. And I remember when I was at Southwest, it was the FOM at the time. I don't know if they still call it that, or they combined all the manuals or whatever. But we had this thing in the front of the manual called Foolish Pride. And I wish I still had a copy of that, because it was talking about flying, and it was really alluding to, your humility as a pilot and this discipline, and not being prideful, because if you're prideful, you make poor decisions. And I loved it. In fact, all of the risk management in the world of the airlines, flying, military, whatever, is is really similar to the world of investing. And I think they borrow and steal from each other. In fact, like you said, with manufacturing and airlines and other industries, there's a lot of overlap there. It's fascinating.
Yeah, definitely. I see this in pilot training too. Like, the humility is such a big deal because we're at this point in our careers where, I have 4,000 flying hours and I'm flying with somebody with 50. So that gap is easy to lure yourself into this. Like, I'm above the person I'm flying with, or they don't know how to make decisions. And I'm this, like, in my own kingdom. But I will tell you, with flying with student pilots, like, I've made plenty of mistakes, and the ability to learn from the person sitting next to you, no matter how experienced or inexperienced they are, happens all the time. I mean, daily, weekly, I'm learning from people. So I definitely think that plays a huge role in aviation for sure.
Yeah. Is there a correlation? I should ask the question about more experience and more mishaps. I mean, what's the studies on that? I know complacency is a constant battle when you get to the 4,000 hour plus point, but what do you think? Any thoughts on that?
I think there's just like this, you've seen the stress curve, right? Where, like, a certain amount of stress is good. Yeah. I think that, like, experience overall, I fly with guys with 10,000 hours of flight experience. So experience kind of lays this, like, foundation, just because they've seen mistakes happen their entire careers. Mm-hmm. But I do think that the further that gap gets, the more complacency can set in. Yeah. So I've heard this correlation, and I'm reading a book, Hidden Potential by Adam Grant. He does a great job explaining just how somebody with a vast level of experience is harder to convey that knowledge. So someone with tons of experience has trouble conveying the knowledge to the beginner. You know what I mean? Yeah. So it's kind of this middle ground of, the further you get in your airline career, I think there's probably a peak in your flying level experience when you're at your very best, when recency and complacency hasn't set in, but you're flying a lot, you have a decent amount of experience, but you still are aware that mistakes can be made. Yeah. So I don't know, maybe the perfect pilot is like mid 40s. And
hey, that's you. Wait a second. That's you.
Almost. Almost.
No, yeah. I'm not that old.
No, I think that, the peak of my pilot career will probably, be somewhere around that stage.
And then you'll leave and be an advisor full time is what I'm thinking. So
yeah,
anyway,
I like it.
But awesome, John. So tell me something really interesting about let's get personal, man. Give us something interesting about family, kids, spouse, what's going on in Enid, anything interesting.
Yeah, I think my life is pretty busy at the moment. So between 3 jobs, airline career, life going on at FedEx, we're in negotiations. But I think really just everything. It feels like it's like coming to a culmination in this stage, So we're thick into the sports with the kids. We're following them around, watching baseball, basketball, soccer, dance. So that's really what's going on in my life. I don't have a lot of free time, but when I do, it's really just hanging out with the kids and hanging out with my wife and keeping up with the daily in Enid, Oklahoma. It's still hot there. I don't know why. I don't know why it's still 100 degrees in September, but no, we love watching our kids play sports, and that's really when I'm not on the road. You can catch me at the local ball fields for sure.
That's awesome, man. That's going to be fun. And by the way, you better establish a special savings account. It's already started, but when those little kiddos are in high school, and I've learned this from all of our clients, it gets expensive. You got all those kids in travel ball and all that stuff, right?
So, oh yeah. It is not for the faint of heart. You have to commit to it. But it is nothing more rewarding, I think, than watching your kids do something they love.
Absolutely, man. And I'm lucky. My daughter's picked a very inexpensive sport. Should be pretty easy. She rides horses. So.
Oh yeah.
So
you got to feed kids and horses.
That's right. I'm going to take a loan out, second mortgage, and anyway. So
Well, good news on the loan. The Fed rate's going down, right. So you'll be able to borrow money cheaper.
Good transition, man. Good transition. So that's what we're going to talk about. With the Fed cut the rates. In fact, this podcast will go out a couple of weeks after this happened. But the Fed cut rates by 50 basis points, which is probably more than people thought. And so, I love Ben Carlson. He writes a great blog called A Wealth of Common Sense. So he wrote about that today and what the Fed rate cut means for the economy. So we'll talk about that just a tad. But John, what do you think off the top of your head? I mean, as we talk about this kind of stuff, anything you're thinking about as far as a rate cut?
Yeah, I think the big things that the Fed rate cut really means is just, borrowing money is going to be cheaper, whether that's for the consumer or that's for businesses. Borrowing money is, 50 basis points less now. Yeah. So I think you'll see some of that show up in the day-to-day, the stock market, but I wouldn't get too caught up on that because there's so much that goes into the economy. People will say the economy and will equate that to the stock market, but those things are not the same. Exactly. So the overall, like the Fed is this bipartisan organization that basically worries about the economy. And I think, shout out to the podcast you guys had with SEMA talking. That was super interesting on how in depth they go into discovering what's going on in the economy. It's not just a look at equities. They, go down on the streets and talk to people, what are goods costing? What's business like? So I think there's more than just, we seem to be like waiting on the next words of Jerome Powell at every meeting, but, look for even what's written in the tea leaves when he speaks. But I think it's just a small aspect of where the economy is going. I think that a Fed rate cut really just means that there are signs that the economy is slowing, and the Fed is trying to counteract that by allowing businesses and consumers to borrow money at a cheaper rate.
Yeah, absolutely. That was podcast Flight 88 a couple weeks ago that we put out with Seema Sheth. And it was fascinating to get her perspective as somebody that's involved in the Federal Reserve. And it's kind of like you're saying, it's much more complicated than, as human beings, we want to really simplify things. That's just our brain's way of dealing with complex situations. We want to really, really dumb it down, so to speak. And so a lot of times we think, hey, the rates are being cut and it's happening because we're going into a recession. In fact, you could Google or get on whatever online and you could already see some talking heads saying, too late, we're already in a recession. We have no idea that that's the case. It doesn't have to be the case. It doesn't mean, in fact, this is one of Ben Carlson's first points. He says, there are no guarantees in markets or life for that matter. The rate cut helps the soft landing, but you never know what's going to happen. You still don't know. And so he kind of inverts this question and says, what do Fed rate cuts, what don't they mean? If I could say that again, but they don't mean a recession is imminent. It doesn't mean that, so sometimes we've had rate cuts and then it's been followed with a recession and sometimes we haven't. In fact, he's got a pretty good graphic on his website that shows the exact number over the last several years, but it doesn't mean anything. In fact, Alan Greenspan in 95 reduced rates, and it was followed by one of the biggest stock market booms in history. The next 4 or 5 years went on to be pretty spectacular. So it would be very risky to try to go, the rates are coming down, and therefore it means this. And it's way more complicated than that.
Agreed. The stock market is such a fast-moving machine. I mean, today, the way information comes out, that it's not just one or two factors that are going to, like you said, we like to simplify it in our brains and say, oh, the Fed's going to cut rates, equities are going to go up, so now's the time to buy. That's such a simplistic viewpoint. So there's so many factors that are going to come into play when you're talking about stock market movements and the economy in general.
It's amazing how complex it is. The other 3 points that Ben Carlson made in his article were that just because the Fed cuts rates, it does not mean that inflation will return. Obviously, the rates were high to tamp down that inflation. And so somebody might think, well, if you lower inflation, then economic activity speeds up again, and then inflation goes higher. That's not necessarily the way it happened. We've had low interest rates for 10, 15 years prior to 2022, and we did not have high inflation. And then, of course, a lot of times people think, all right, rates are coming down, the stock market's going to go up. Again, another definitive thing that you cannot jump to that conclusion. And people sometimes use the phrase, it's a Fed put. And put is a term in the stock world of creating this floor of like the stock market can't go any lower than this floor. And that's just not the case. It's not necessarily a fact that the stock market will go higher, although you can see that it's kind of like a sugar high in the short term. When the Fed lowers rates, the stock market does quote unquote like it. And in the short term, it does seem to go up a little bit, but that's really about all you can infer from that. So.
Yeah. No, it makes total sense. I think we have to think about just all of the human emotion that goes into the stock market. There are truths to what the Fed rate cut means, but I think if you're a general investor, then the stock market going up or down it's just very hard to guess. I mean, it's very hard to control that outcome. Yeah. So I think, take the rates. There are the things that will happen are, borrowing money will be cheaper, mortgage rates will decline, and those things will then affect those specific markets. So whether that means housing prices will continue to go up or housing prices will come down, there will probably be more houses on the market. There will probably be more people wanting to buy houses if rates continue to come down. That may be true, but there's too much in that. What decides the outcomes to say that the Fed rate is simply going to do one, raise equities or lower equities or, downturn is coming. Yeah. I'm sure the news will fill our computer screens and phones with, it's going to be good, bad, they'll span both sides of that, probably tell you that the next market downturn is coming, and we'll hear about that for the next few years.
Yep, absolutely, man. It's the next storm is coming. Somebody will predict it, and it's going to happen at some point. It's a natural part of the economy, and I'm talking about a recession, but there's no guarantee predictor of that. But in summary, Ben Carlson says, I guess what I'm trying to say is that not much is guaranteed by Fed cutting rates. You should expect rates on your savings accounts, CDs, and money markets and T-bills to fall immediately. Those are all correlated with those short-term rates that the Fed controls. You should expect borrowing costs to fall. Other than that, the future is uncertain, just like any other time. So I think that's pretty well put anyway. But John, with that being said, let's jump into today. We're going to jump back to that topic. You and I talked about the book that we love, The Psychology of Money by Morgan Housel. We're doing a book study and at Leading Edge with this. Every week we kind of go over this a little bit to kind of review it as a firm, which has been really fun. But for me, John, this ranks pretty high, man, as far as the books I've read lately. In fact, the two, to me, most influential books I've read recently, last several years, are Atomic Habits by James Clear and The Psychology of Money by Morgan Housel. And so we want to go over some of the principles in the psychology of money today, and that are just, I think, really key to success as an investor and, for people's retirements. But what do you think, John? Any thoughts on that?
No, I think the success of Morgan Housel has come to how applicable this book is to just everyday people. Just anybody can read this book. It's not overly complex. It doesn't get into, market movements. It's just in general kind of display of how people deal with money and how it ranges from whatever your background is or what your preconceived notions about finances, what mistakes you've made in the past. It does a really good job of capturing the relation of money to your happiness. Mm-hmm. And I think that's something that's hard to see. And like wherever you are in life, everybody has goals. Everybody has things they're trying to accomplish with their money in their life. And he does a really good job of focusing that attention and saying, that maybe it's not the goal itself that we're trying to accomplish, but just our mindset around money. So I would recommend it for anybody, but I think his success is really tied to just how applicable it is to everybody.
Yeah, it is. And he talks about how you don't have to be the smartest person in the room to be successful with money. In fact, he gives multiple examples. One of my favorites is the gas station attendant / janitor that ended up with like $10 million at his death, and nobody ever knew he was wealthy. But it was just his behavior, his discipline, clearly wasn't like this guy aspiring to have millions and millions. He wasn't ambitious, but yet he did all these things, these good behavior traits that we're going to talk about today, which are fascinating. But John, we'll start off this discussion. What do you think is the number one attribute to being successful with money? If you could have one quality, one skill, what would it be?
That's a tough one. There's so many that come to mind. There's certainly there's certainly life attributes that you talk about that are great for being able to accumulate wealth, like discipline being one of them. But I kind of group this into one idea, maybe not like one trait that I have, but one like piece of knowledge that I could go forward with is behavior over knowledge. Mm-hmm. Like there's so many things you can learn about money, but if you don't fix your behavior, or if you don't focus on your behavior, then all the knowledge in the world can't help you grow your wealth. So I think the big thing about behavior is you control it. So your day-to-day, people are attracted to the finance world and the stock market, and you can get as deep as you want into strategies on how to invest, how to get the best market returns, because the stock market's super complex. And but I think people most of the time, and people that I've dealt with in the financial planning world, clients that I've talked to, it's hard to look at your own behaviors and diagnose what's going wrong. Mm-hmm. So I think more than important than finding the right method of investing is controlling your daily activities. Yeah. And I think that a lot of, financial expertise out there, whether it's Dave Ramsey or Ramit, they talk about this, right? Like look at yourself in the mirror and say like when people are in bad financial situations, looking themselves in the mirror and saying like, I got myself here is a hard thing to do. Yeah. So behavior over knowledge is where I'm going with.
That's good. I like it. My answer was one word, and that was just humility. But I think it's what you just alluded to, like look in the mirror, have the humility to go, I don't know all that's going to happen in my life. And I'm not talking about from an advisor's perspective, a client's perspective. I'm talking about even when we do planning with clients, we have to plan with the idea that there's a lot of stuff we don't know. And that stuff being life, what's going to happen in life, and how we're going to react to it. But I'll start us off with this book intro. We'll just hit a couple principles here really quickly. But I love this intro that he has. And it was also, this little story was also in the book by Jack Bogle from Vanguard, the founder of Vanguard, called Enough. But he included it, Morgan Housel included it in this book as well. And he says the founding premise of this book, being Psychology of Money, was an actual conversation that occurred many years ago. Two famous authors, Kurt Vonnegut and Joseph Heller, are talking at a party hosted by a billionaire hedge fund manager. Kurt says to Joseph, this billionaire makes more money in one day than you made in your whole lifetime from your novel Catch-22. And Joe responds, yes, but I have something he will never have, and that is enough. And so, it's this idea that there's a lot wrapped up in there, right? There's a comparison, there's envy, there's contentment. And so all of those emotions that are very powerful and strong. But the first principle that I think resonated with me, John, was in the book when he quoted Bill Gates, and Bill Gates said, success is a lousy teacher. And basically the premise there was, sometimes we're successful, sometimes things go well, and this applies to the investing world, and we give ourselves maybe too much credit for that. Maybe there's a little bit of circumstances, maybe a little bit of luck, And I think it applies to sports. I think sports is the best analogy, or even flying. I remember going out flying, John, in the Air Force, and we'd come back from the mission or the sortie, and we'd go, "Hey, things turned out pretty well, but quite frankly, we got lucky. We really we didn't execute the game plan we were supposed to." So you tend to give yourself a pass when the result is good. Pat yourself on the back. But if you're really honest with yourself, you go, "Hey, wait a second. We got a little bit lucky today. Let's dig into what really happened and understand that success is a lousy teacher and failure is probably too extreme as well, because sometimes there's a lot of good things you do in that." And so I don't know, John, what do you think about as far as that's concerned?
No, I think that's a really good idea. When it comes to finances, we can look back on just like our trades, right? We can say that I bought this stock or I bought this ETF at a great time, and now I'm like the king of all things finance. Look at my returns from last year. Yeah. That's an easy one to look back and say like, man, I did this really smartly. But a lot of times it was just circumstance. Like I didn't know 10 years ago that the S&P 500 was going to grow the way it did, but I was really lucky to have invested, a big portion of my finances like in investments in that. But equally, you can turn around and say, we tend to like focus on those things and get away from the failures like that. I think that's just human nature to look at the successes and attribute those to, my intellect or, my hard work and discipline. But in the reality, I think that we avoid the bad things that happen and we brush over them, especially in the aviation world. We make mistakes and we're like, well, nothing bad happened because of that, so we'll just kind of brush it off. But in reality, we should look at them and say, how can I prevent that from happening in the future? Yeah.
And it may not go so well. Like the S&P may not be the thing in the next 10 years, and that's a great example, because a lot of people say, hey, we should have invested this way. We lost X amount because we didn't invest a different way. And it's like, well, we only know that because of hindsight, and it could have gone the other way easily. There was no certainty there. And so I think that's the tough part sometimes about investing and flying and any other part of the job as well.
Right.
The other one that I loved, and I know you commented on this one, but he said the hardest financial skill is getting the goalposts to stop moving. And I experienced this personally and in our business, where the consultants will say, you got to have business goals. And so we pull this goal out of thin air, and then you achieve that. You're like, okay, well, we've got to make it bigger, or we've got to do this. And so that's a slippery slope, John, as far as, man, when's enough? And a lot of our clients will say that. Well, how much is enough? And I don't know, you know what I mean? And so that's part of our job, I think, is to help with that, solve that puzzle, if you will.
Right. This goes back to your James Clear idea. And he says, you don't rise to the level of your goals, you fall to the level of your systems. I think goals are important. I don't think there's any argument that setting goals is critical and finding, just what works for you, or finding, it gets the receptors in your brain. You're happy when you meet a goal. Yeah. But I think that goals are constantly moving. And so then probably the more beneficial question is, when do I hit the point when I'm financially independent, or when can I start pursuing these things that really give me fulfillment in life? And I think we just come back to that. My like real life scenario is I'm working with a couple of clients that retired right before, I guess, like end of 21, and the stock market was down, and all of these things happened that were totally out of their control. So the number they had in their brain of, hey, when I hit this number, then all needs are met. I can quit work and I can go do these fulfilling things, travel the world. And then 6 months later, that goalpost moved without any action from them. And so then I think we just have to kind of go about this as a theoretical idea of, if you woke up tomorrow and the dollar figure that you were trying to hit in your 401k, what if it was just there? What if you had $5 million in your 401k? how would that change what you do on a daily basis? And my argument there is it probably wouldn't change much. I think more money or less money really just kind of brings out the same attributes that you have as a human. People with more money, they just go bigger. If you have this spending habit and you like to spend money, the more money you make, the more you're going to spend. Yeah. If you're an investor and you're very frugal, the more money you have, the more you're just going to invest. Mm-hmm. So I think it just exacerbates those original ideas and the attributes that you already have. Like the dollar number really doesn't matter. So I think when you look at somebody from a financial planning aspect, you have to mark those down and kind of say, like, what are the goals? Should be more fulfillment, happiness. Yeah. What are the most important things in your life? And then how do we go about accomplishing those things where you can do them freely? You can do them without any anxiety. You can do them, without having to rely on a business that you work for or your own personal daily expenditures. So yeah, I think that's part of the book too, is really just finding that, and contentment is the word that comes back to that situation. So the moving goalpost, you'll work your entire life and that goalpost will continue to be 10 steps ahead of you. I don't think that's a bad way to live. But I do think that we have to keep that in mind.
Yeah. I read something the other day, and we talked about this in our office as far as goals and progress. And we always want to be improving and getting better. And that's okay, but at the same time, if that's your only focus all the time, and maybe in this circumstance or this context, more money, all the time. Again, more money is okay. But what we talked about in our office and what I read the other day was, it's okay to be content and still have ambition at the same time. But how do you do that? It's really hard, because if I have these ambitious goals with money, then how am I content at the same time? And one thing I read was phenomenal. It said, well, you look back. You don't look forward all the time. You look backward and go, where have we come from? And I think that allows that contentment. And that's just being grateful, right? I look where we've come from, man, I'm here in a position we never thought we'd be here. I'm content, I'm happy, I'm grateful. And here's an ambitious goal that we have, and I think that's maybe a technique to be able to balance that. I hope, but it's not easy for sure. So,
yeah, I think that idea is similar to a discussion I have with a client a couple of weeks ago. And it was like, look back 5 years, if 5 years, 10 years, like if I could have shown you the life you have currently, like, would you sign up for it? And I think in most case, when I talk to people, they're like, oh yeah, like if 17-year-old me could have seen 37-year-old me, I would have signed up on the line. I would have said, that sounds fantastic. But then in the daily, I think we're wired to always, want more. And whether that's like societal or whether that's your upbringing, I think this, mentality that we're always striving for something more is a good quality, but you just have to be able to find the moments in your life to celebrate. So it's a fine balance for sure. Razor's edge.
It's like that tension, constant tension. That's healthy tension though. It's good. We got time for a couple more, John, but the one that I put in there that I think just saying this out loud alone makes you sound stupid. So I'm going to say it and then talk about why it's true. But in his book, Morgan Housel says, good investing isn't necessarily about earning the highest returns. If I said that to like a prospective client, they would be like, that's the dumbest thing I've ever heard. We're going to go to your competitor and see you later. But there's truth in that, right? I mean, the truth is so much more complicated in that statement. And he writes about, I think this is where he's writing about Warren Buffett and why was Warren Buffett so successful? And it was really time in the market. He started investing when he was like 12 years old or something, and is age 90 or something. And in fact, he highlights this other person that actually has a better record of investing than Warren Buffett. His name is Jim Simmons. In fact, right here, it says, head of the hedge fund Renaissance Technologies has compounded money at 66% annualized since 1988. No one
Wow.
comes close to this record. As we just saw, Buffett has compounded at roughly 22% annually, a third as much. But yet Warren Buffett gets the all the books. He said there's 2,000 books written, I think, about Warren Buffett. And he says, but the most powerful and important book should be called Shut Up and Wait. Because that's what Warren Buffett did. He invested in a way that he could sustain, he could survive, and he just stayed consistent. So last thing I'll say here is he says, good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that cannot be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. So I think that's a really tough concept for us to think about when we're investing from day to day, week to week, or year to year even.
Yeah, interesting, psychological idea there is, delayed gratification and finding contentment with where you're at and being okay with waiting for those compounding returns. I think if we would talk to our parents about money, they would tell us probably those things, just like it's all going to work out. Like, don't stress about it. Find something methodical you can do. Set yourself up on those systems where you're automatically investing, where money doesn't even come to you. It goes to your 401k. These are the things we preach as advisors and planners. But I think that chasing returns is really the thing you don't want to do. Yeah. So finding, there's been tons of studies out there. Like, you can go out and Google the highest earning ETFs and index funds on the market today, but what they earned over the last 3 years is not indicative of what they're going to earn for the next 3. So you can chase these returns, but you're probably going to spend a lot of time doing it. You're probably going to spend a lot of effort and probably a little bit of stress in finding the right things to invest in. Now, I'm not saying that you can't go out and try to beat the index or, find the right companies to invest in. But I would do that only if you like it. The highest return, I always compare somebody that's chasing returns, but doesn't have a lot of money to invest. Like, whether you make 15, 18, 22%, Warren Buffett, the amount of money you have to invest is way more indicative of reaching high wealth. So that comes back to my daily activities and to say, like, if you can find $300, $400, $500 extra a month that goes into an investment, you don't really need to make 20 something percent on average in order to build the life that is going to give you freedom in your finances. Yeah,
that's a great point. You're right, man. It's the heavy lifting is the behavior, the savings. But John, you get the last one there. You talked about seeking financial independence. I think on this last note, what do you have there for the last point there on the book?
You got it. Financial independence is something we've seen kind of come to the forefront. You see the FIRE folks, and they're cutting down lifestyle and putting 40, 50, 60% of their income into investments in order to reach this spot where they reach financial independence. And I think the psychological effect of that is what we've seen in these people that get financially independent in their late 30s, early 40s, and then they kind of lose this fulfillment aspect. So they're completely free of work. They have this financial independence that they've sought, but then they return to work 4 or 5 years later because they're looking for fulfillment. So I think the biggest key to financial independence is to establish these goals of what you want life to look like. Where do you want to seek happiness with the ones you love, fulfillment and freedom? Grab that financial independence as soon as you can, but don't let life trickle into your paycheck is my idea there. So I think getting to a place of financial independence doesn't mean that I stop working right away. Instead, focus the areas of your life on the things that fulfill you. And whatever those goals are, like, that's essentially my job as a planner or financial advisor. It's not to find you the highest returns. It's to look for inefficiencies, and it's to talk to you and know enough about your life to get you to a place where you can have that financial independence. So I think if you focus on that and how do you reach a level where you can live life without having to work full time, or just live a life that's going to bring you fulfillment doing not the job you have, but the job you want. That's the biggest thing that somebody can help you with. So I think that's it's a tough one to nail down, but I think the people that would say they're most successful with money, and that doesn't mean they have the most, but the people that are the happiest and have enough have sought those goals out and have reached a place where money gives them freedom.
Yeah. Wow. That's well put, man. I love that, because sometimes we chase this never ending goal, like we said, the moving goalpost of just money, just money, just money. And then we get there and it's the saddest thing when, like you said, it's not fulfilling. Whereas if you put some thought, like you're saying, into what is fulfilling, what do I really want? And that takes a lot of soul searching. And that was awesome. I love that point. That's a good one to end on. And John, thanks for sharing that with us. We appreciate your perspective on this stuff. It was a great book. We go recommend everybody take a look at that, because it's just a very, I think, refreshing, different perspective on money. And I think it's the most effective, not just interesting, but I think it can allow people to be the most successful if they develop that framework for money. So John, just in leaving here, I want to ask everybody if they can go to our Pilot Money Guys, wherever you get your podcast, go give us a review. Write a review, give us a rating there, especially on iTunes. That helps us to get our messages out to more people. And we want to just kind of share these thoughts with more people if possible, and maybe help wherever we can. So John, thanks for being a part of that today, man. It was fun to have you on the show, and we'll talk to you again soon.
Of course, Charlie. Thanks for having me.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.